let's cover bank income and expenses. Conveniently, the sources of revenue for banks are three major ones, as well as the three major sources of expenses, so they're very easy to identify. Depending on the business that they get into, banks may earn revenue from interest income, from fees and commissions, and capital markets activity, but the majority of that revenue is from lending, what's known as the interest income, or once it's net, known as the net interest income or NII. But let's take a moment to really slow down and take a look at all of these types. Naturally, banks perform different activities depending on their specific focus. But in general terms, their income streams are majorly of three types: interest income, fees and commissions, or trading income. So let's cover interest income. This is generated from the bank's lending activity and its interest-bearing assets. In other words, they charge for lending money. Now here's the thing. When we talk about what the bank earns only, that's the interest income. But when we subtract the bank's funding costs, we reach a KPI that's named NYI, or net interest income. In short, it's the total interest that the bank charges minus the total interest that it pays. And naturally, the higher the interest rates on the loans and the lower the interest rates on the deposits, the bigger the increase in net interest income. Then we have fees and commissions, and these come from a variety of services. They are the most robust source of income because they're not volatile or susceptible to market risks. They may include fees for bank transfers, transactions, security operations, such as losing your PIN number, issuing cards, replacing cards, and many others. And then we have trading income, or capital markets income in general. And this is income from trading activities, both as a dealer and a speculator. So if the bank makes a market on a security and sells it, they earn commission as a dealer, but they may also speculate in that security themselves, earning capital gains in terms of trading. And if you're thinking that there may be a conflict of interest here, you would be right. For example, during the subprime crisis of 2008, many banks were selling their own internal CDO products to get rid of them, while at the same time recommending them publicly to their clients. They have one attitude as a trader and another attitude as a broker. And that's why there was further regulation after the crisis to limit the asset management arms of banks. So these activities can involve anything from market making, underwriting, proprietary trading, management fees for managing assets, and more. And likewise, banks also have three major types of expenses. So the first type are operating costs. These are the costs of, well, operating. So paying rent for branches, keeping people on staff, whether in branches or internal offices, such as, for example, for risk management or fraud prevention, but also IT systems, office equipment, other services, such as licenses or consulting services, also come in here. Then we have the funding costs, and these are the costs of obtaining funding for the bank. So it's advertising and other methods of customer acquisition. Out of all different types of depositors, individual depositors, so retail consumers, are almost always the cheapest type of funding. And please realize that in this case, we're not just talking about the actual interest on the deposits of these customers, we're also talking about the actual costs to obtain them. So if you're wondering whether this is the cost of customer acquisition or the interest costs of depositors, it's both. And finally, we have loss provisions. In short, these are quantities of capital that are set aside to provision for losses in loans due to borrower default. For example, if you have 100 million in outstanding loans and you estimate that 2% will default, then you need 2 million of reserves, period. And here's the thing, these amounts for provisions are very unique to the specific banks due to their specific default rates. Every bank has a unique DNA in terms of their borrower base. For example, the same exact bank with the same services in two locations would have very different default rates, especially if they lend to local businesses. And it's important to note that these are vulnerable to market risks. For example, in bear markets, a lot more companies go bankrupt, or at least they default more frequently. So provisions can differ in terms of the amount based on the cycles. One last important aspect that is a core essence of a bank's business model, and that we talk about several times in this course, is the concept of maturity transformation. So this is based, first of all, on one fact, which is that a bank has two opposing forces. On one hand, they have deposits. They fund the bank with capital, but they charge interest to the bank. They have to pay for them. And the other force are loans that take capital out of the bank but provide interest payments. They are perfectly symmetric. And both of these have what are known as the maturities. If you don't know a lot about that, the maturity is simply the term of the loan. So if you take a 3-year loan, it has a 3-year maturity. And here's the thing, deposits may also have a maturity. So you can have a 5-year savings account, a 20-year savings account, and so on. So the key here is that ideally, these must be matched to maintain liquidity. So for example, if you have 500 million in 3-year loans, you should have 500 million in 3-year deposits, because otherwise you run the risk of the deposits going out and you still need to pay loans, or the opposite. So the ideal would be a perfect symmetry, but in reality that never happens. Deposits are always shorter. It's very hard to get someone to commit to a 5-year savings account, but it's very frequent for you to be asked for a 5-year loan. So maturity transformation is the name given to obtaining short-term deposits to fund long-term loans. This is always present in banking and it must be managed. In other words, banks always lend on longer terms than the deposits that they have, which on one hand is good. It gives them a long-term income. The interest that they receive lasts longer. But on the other hand, because the deposits end quicker, they have to be renewed more often. And this kind of gap in the maturities must always be managed. This is why, if someone liquidates a 3-year loan, for example, for 10 million, ideally you would liquidate a depositor for a 3-year deposit, but more likely you'll try to find a loan with a 3-year maturity to replace it. But naturally, you can never find a perfect replacement, so you can only mitigate this gap, which is known as the lending funding gap. What are our examples here? The first is that out of the 3 types of income, capital market activity is the most volatile. It's the hardest to predict. It faces market risk, secondary risk from specific portfolios, and idiosyncratic risk from individual securities. That's a lot of risk. And on the other hand, fees and commissions are the most stable revenue. They have no risk. If you charge a $20 maintenance fee per account per month, then that's what you charge, period. Then the cost of reputation, although intangible, is a cost. The cost of upholding a bank's reputation is an operational cost, in a way, because you need to have key personnel trained to provide quality information on all bank products, as well as provide high quality after service. And all of these are costs, with hiring, salaries, enablement, certifications, and more. And finally, while the costs of funding are something to definitely take into account. The liquidity is another factor. What I mean is the following. A wholesale funder can more easily cause what's called a run on the bank, so taking out a large amount of depositors. Take the following example. If you have one pension fund depositing 100 million, which is a wholesale deposit, versus 100 people with 1 million each, or even 1,000 people with 100K each, what do you think is easier to happen? Losing that 100 million from one pension fund, or losing all those 1,000 deposits from 1,000 people? Exactly. This is why liquidity is very important as well. It contributes to the stability of the bank's capital. What are our key takeaways here? The first is that there are three types of income. A bank usually obtains income from loan interest, the major one, from fees and commissions, the least volatile one, and from trading activity, as a dealer or a player, the most volatile one. Then, a bank usually has as expenses three main types: operating costs, so office rent, people, IT, etc. Then the funding costs, both obtaining customers to deposit money and the interest that you pay to them. And finally, loan default losses, set aside in the form of provisions. And finally, the concept of maturity transformation. The net interest income is the difference between the deposits and the loans. So ideally, the loans and the deposits would be perfectly symmetrical in maturity, but that usually doesn't happen. Deposits are shorter term, and they originate longer term loans. So this allows to obtain long-term fixed income while paying short-term fixed income. But it also creates risk because the deposits must be renewed at a higher rate. So as we see, banks usually have three major sources of revenue as well as three major sources of expenses. But the major source of revenues for banks is from lending because that's their primary activity, the NII or net interest income.